So, we're going to talk today about offshore entities or any type of offshore structure that is used to hide rightfully taxable income here in the United States. When does legitimate offshore tax planning become a criminal tax problem here in the United States? Well, to begin with, owning an interest in an offshore company is not illegal. It's not illegal to have a foreign trust. It's not illegal to have a foreign partnership. It's not illegal to have a foreign foundation or a foreign bank account or multiple. It's not automatically illegal. Thousands of U.S. taxpayers legitimately use offshore entities. They do it for international business reasons, investment reasons, estate planning reasons, or for asset protection. The danger kicks in when the offshore structure is no longer being used solely to conduct some sort of business offshore, but it's being used to hide rightfully taxable income from taxation here in the United States, or to conceal somebody's ownership in offshore assets, or to make offshore assets fraudulently appear to belong to someone else. That is when a legitimate international structure can become the centerpiece of an IRS criminal tax investigation. Hi, I'm David W. Klasing. I'm a dual licensed tax attorney and CPA, and for more than 25 years now, my team and I have represented taxpayers with complex international tax, offshore reporting, or IRS criminal investigation problems, and we deal with cross-border tax controversies all the time. Today I'm going to explain when an offshore entity becomes dangerous, what the IRS is actually looking for, and why legitimate tax planning can become criminal tax exposure when the facts no longer match the legal structure. Well, if you get nothing else out of this video, offshore does not mean invisible to the U.S. taxing authorities. Many taxpayers assume that moving income-generating assets overseas places them outside the reach of the IRS. Listen, that assumption has become increasingly dangerous. Today, the IRS receives foreign financial information through FACTA reporting, through international information sharing agreements, through treaty partners, through foreign financial institutions under FACTA, through whistleblowers, through civil examinations is where things blow up, and the IRS criminal tax investigations on their own. So, foreign does not mean hidden, and it certainly does not mean immune from U.S. taxation. For U.S. citizens, resident aliens, and many domestic entities, worldwide income remains subject to U.S. income and foreign information reporting requirements. So when does the offshore structure no longer match reality? Well, when the IRS starts looking at foreign activity, it generally focuses less on the paperwork and more on the underlying economic reality. An auditor or criminal investigator is going to ask questions like, who controls the money offshore? Who signs the contracts? Who directs the offshore banking institutions? Who communicates with the company's customers? Who controls the underlying passwords? Who receives the economic benefit of what's happening offshore? If a taxpayer claims that income the government's looking at belongs to a foreign corporation, all the while personally controlling every meaningful decision of that offshore entity, the legal form of that offshore entity may no longer match the economic substance. That disconnect often becomes the government's starting point in unraveling an offshore situation. So what are the red flags the IRS is looking for here? Certain facts are going to immediately attract attention. These include nominee shareholders, nominee directors, shell companies, false consulting agreements, undocumented loans, backdated contracts, personal expenses that are paid by offshore entities, hidden beneficial ownership of offshore assets, accounts that are held by foreign entities instead of the individuals that really own them, layered entity structures designed to disguise ownership, and taxable foreign income omitted from U.S. tax returns. Listen, one red flag here may be explainable. Multiple red flags over multiple calendar years often creates a very different picture. Let's talk about offshore entities that create U.S. reporting obligations. Many taxpayers believe that if there's just a tiny bit of tax that's owed here, There's very little risk in claiming the income or doing the foreign information reporting. Unfortunately, that's not how international tax reporting works. Depending on the facts, an offshore structure may require a lot of different types of reporting. Form 5471 for foreign corporations, Form 8865, Form 8858, Form 3520, Form 3520A, Form 8938, and FBAR reporting, foreign bank account reporting. Each of these information returns serves a different purpose, and filing one form does not automatically satisfy another. The IRS uses offshore information reporting to understand who owns the foreign entity, who controls the foreign entity's assets, what potential income is being generated by this offshore entity, and whether that income was properly reported for U.S. purposes. Missing information returns can trigger significant civil penalties even when little additional income tax is due. So how do civil audits become criminal cases? Many offshore matters begins as civil examinations. An information document request, questions about foreign accounts, requests for entity records, beneficial ownership documents, bank statements, transfer histories. The danger kicks in when the facts suggest affirmative concealment of offshore income, false income tax returns, or any deliberate efforts to disguise ownership of offshore entities. If that happens, the government's focus is going to change. The objective is no longer simply correcting a tax return. The dangerous part is it shifts to determining whether a criminal tax violation has occurred. So what not to do here? Once a taxpayer realizes their offshore reporting contains problems, a lot of times they panic. They dissolve foreign companies, they close foreign accounts, they move funds, they delete emails, they rewrite agreements, they backdate documents. They ask the people involved to change the story. Listen, those type of actions rarely improve the situations. Instead, they often strengthen the appearance that the offshore structure was intended to conceal reportable U.S. income. Whatever you do, preserve the evidence and don't try to rewrite history. So let's talk about choosing the right compliance path to come back into compliance. Well, not every offshore problem requires the same solutions. For taxpayers that acted non-willfully, they just didn't understand the law, therefore they didn't comply with the law, you may qualify for what are called the streamlined compliance procedures, or there's other civil correction procedures. Others, where there are multiple badges of fraud in the fact pattern that suggest they acted willfully, things like hidden offshore income, false income tax returns, or anything they can point to say there's been affirmative concealment of offshore assets. In those situations, choosing the wrong filing strategy can provide the government with a roadmap for a criminal tax and foreign information reporting case. That is why obtaining legal analysis must come before you choose to do anything. So in closing, if you own or control an offshore corporation, a foreign partnership, a foreign trust, a foundation, a foreign bank account, or any type of international structure, if you're concerned that the income from that entity may not have been reported, or that the ownership was hidden, or that any type of information or income tax reporting may not have been handled correctly, whatever you do, do not attempt to dismantle the offshore structure or file late forms without experienced legal advice. At the tax law offices of David W. Klasing, our dual licensed attorneys and CPAs routinely analyze offshore entities. We look at beneficial ownership. We look at international information reporting, things like FBAR compliance, Forms 5471, 8865, 8858, 3520, 3528, 8938. We look at all of these issues through both the civil and criminal tax defense lens. Our goal is always to preserve your credibility, reduce any criminal tax exposure, and mainly intervene before an offshore reporting problem becomes a criminal tax prosecution. Call 1-800-681-1295 or visit Klasing-associates.com to schedule a confidential, reduced rate initial consultation today. because having an offshore entity can be perfectly legal, but using them to hide offshore taxable income creates potentially life-changing civil and criminal tax exposure. Call us today. Offshore issues are up to 60% of our book of business. We really excel at fixing these types of problems. Dave Klasing, tax attorney, CPA.